what is the end game? What are you trying to achieve? I mean, there's no wrong answer, but there definitely is an answer, and you really kind of need to find that answer because I think it helps frame how you approach your business. I've got a short period of time here, so what I really wanted to do is provide a different perspective on sources of early capital, and it's really focused towards the entrepreneur and maybe help shed some light on some considerations and some questions that people often don't ask of themselves as they embark on this journey. Before I get started, I think it's important to give you a little bit more background on my bio, because again, at the end of the day, it's an opinion set, and I want to give you a sense of where these opinions come from. So my background, I mean, I'll be quick. Academic, I did a civil engineering degree a long time ago at Waterloo. Years later, I did an MBA at Ivy. I've worked in big corporates. I started my career at a multinational with Ericsson in a product management role. I've worked in telcos and corp dev. I spent 10 years in venture capital. So I was most recently a general partner with the BlackBerry Partners Fund, affiliated with JLA, and then before that Summerhill, and did a lot of direct investing in early stage technologies. And then 3.5 years ago, wanted to start a business. And so through that process, realized I'm not an idea guy. I didn't spend a lot of time, wasn't getting anywhere. Hooked up with my business partner who had the founding idea of the premise behind Unata, which is a company I'm currently with. And he had a couple of employees, an early product concept, no revenue, and embarked on the journey as his business partner. So that's 3.5 years ago. We're currently circa about 40 employees. We're contractually locked in this year. We'll be in 8 figures of revenue. We've been profitable for the last 5 quarters, and we've raised a total of $1.7 million in dilutive capital. So we took a very different tack and got ourselves to the place we're in now, and we've got tremendous growth in front of us. And so it's imparted a lot of lessons as a guy who used to write big checks in venture and as a guy who doesn't want big checks right now running a business. There's sort of an interesting overlap. I mean, this first slide, there's really nothing new here. This is just a quick list. There's a lot more sample sets. Again, early capital. I mean, obviously, friends and family, angel network, there's a whole range. People are familiar with accelerators. There's institutional seed investors, professional investors at the seed stage. Then there are professional investors that dabble in seed but are really much larger funds. And then there's other sources. But I would sort of argue before you venture into these different conversations, there's an exercise that I find a lot of early stage entrepreneurs don't go through that really is important because there's a lot of different nuances that come with each of these. And so, there's a number of questions that you need to ask yourself and be as truthful and honest with yourself as possible. And that's, what is the end game? What are you trying to achieve? Is it singularly wealth? Is it, personal development, growth? Is it notoriety? Are you trying to transform an industry? Do you want to be Steve Jobs, or do you want to have a nice cottage in Muskoka and just chill and lay low? I mean, there's no wrong answer, but there definitely is an answer, and you really kind of need to find that answer because I think it helps frame how you approach your business. Do you want to work for yourself, or do you want to work for a board and a set of investors with a different degree of accountability? And underpinning a lot of this, in my view, is how that then connects to what is your long-term funding strategy. And then we'll come back to the sources of capital. And I would argue, I'd throw out a question, and I often ask this of entrepreneurs. Hypothetically, let's say you're 2 years into your venture. You may have raised a little bit of money. Things are going well. You've got a pretty significant ownership. And someone in your ecosystem approaches you and offers you a $12 million cash deal to sell your business. Full stop. What do? And again, there's no right answer, there's no wrong answer, but I think it's a relevant question, and I think people surprise themselves when they answer the question. I mean, that could be a $6, $8, $9 million cash check, and For some people, that's game changer. That may hit your motives. It may not. On the flip side, when I go back to a situation when I was an investor, I was on the other side of that equation. So we were running a $150 million fund. We did do some seed deals. We had invested in a seed company in Montreal that was doing really well. Early days, we'd put $500,000 in to get going. We had a term sheet at the table. Intel Capital was the lead. It was an $8 or $9 million US round, great up round valuation. Everything looked great. Insiders were great. We're going to participate. I mean, it really was a great trending story. And then in comes a partner and offers the guys, the two founders, $9 million to buy their business, and they hit the bid. I mean, they took the bid. And we, so my point in all that, I mean, to the two of them at that point, they still had 80% of the business, 40 each, and for whatever reasons. And again, there's nothing wrong with that, but we were misaligned going into that dynamic. And the point is, as an institutional investor, the objective for me was not to get a 1.5x on a 500K investment. I had limited cycles in terms of who and how I could get involved with companies, and that wasn't what I was looking for. And that's not how it was projected when we embarked on that mission. So that may have not been the right investor class to work with, regardless of the outcome, because it's a small community and it stays with you. So it's something to think about. None of this is rocket science, but I'm always amazed at how many people don't often think these things through. A sample set of questions in terms of understanding the dynamics of your business. And again, it's critical because it ties to the investor class, who to approach and why. There's a lot of early stage entrepreneurs I speak to that will give me an answer of, okay, what's your long-term revenue stream? I'm like, well, I don't know. I'm going to build a big user base. You've heard this story, and we'll figure that out. And I would argue, when I was an investor, I hated that answer. And as an operator, I still dislike it. Hypothesize, create an assumption, figure it out. Just give me an answer. Don't say I'll figure it out later. I don't think that's a viable answer. Different markets and different opportunities have different dynamics. User growth versus profitability. Again, this is sort of akin to the B2C almost to a B2B. And it has different implications on how you think about funding your business. B2C, you're seeing a lot of stories now where it's about funding to market leadership. And that could be viable, but you're embarking on a very different journey. If you're Uber and various other examples, you're seeing that in the Valley. They're doing hyper round fundings for early market leaders to try to own that market. Other categories you can get to profitability. My current business, we have a different tact. Ties into the next. Are you in a hyper competitive market, or is it a little bit more of a mature industry? Same dynamic. We're in the grocery business. We're helping bring to market digital solutions to transform the grocery experience, the concept of e-com, curbside pickup, a digital flyer that's personalized to the individual. We're not racing Uber against Lyft. I don't need to raise $1 billion. I couldn't raise $1 billion, but I don't need to. I wouldn't know what to do with it. So that has dramatic implications on how you fund your business. The obvious ones, size your market. Again, I talk to a lot of early stage entrepreneurs and they don't know. They don't know how to size the market. And it sort of baffles me because how are you going to talk to investors? How do I scale my business? Same sort of thing. So again, the reason these basic questions are here and they're relevant is if whoever you're going to talk to, you need to have an end-to-end story. And if you don't know the answers, that's fine, but then hypothesize. So the challenge takeaway is, create that end-to-end story, understand all the dynamics before you start having investor conversations, in my opinion, because otherwise your story will fall apart. And you should have those answers, whether you know them or not. So if we now go back to this, I want to sort of draw out a couple additional nuances and considerations that may now be more relevant. So again, going on the left side, and again, this is just a sample set of early sources of capital. Couple things to call out. The angel networks, that's a great resource. We brought in about $400,000 through the GTAN network. And that was really effective when we were at a certain stage where they were interested in hearing our story and it fit our model. It's a painful road. I won't deny it. It takes a lot of time, but it's effective. A couple things is I would say at an early stage, my opinion, focus on proximity. Focus on players in the GTA. There's a couple of exceptions. If you can get into a Y-Com, fine, go for it. I mean, there's great notoriety to that, and you'll likely jumpstart your business. If you're a serial entrepreneur who's made a lot of money, you could probably get a US VC's attention right out of the gates, and so be it. Outside of that, you're going to have a hard time getting far geographically distant money to source your early stage business locally. It's time consuming and expensive. There's a lot of resources locally, and focus in on that. There's other sources. So I have this commercial institutions category. I didn't know what to call it, but I'll give you an interesting side story. So we're in the early days of our business. I've got one commercial contract in hand. I'm still less than $300,000 in revenue in my current business, and I get a tweet from BDC of all people. I mean, literally say, hey, like your story, do you want to talk about funding? I mean, it was a tweet. And I thought, well, I'll entertain the conversation. An hour later, I'm on the phone with the BDC Entrepreneurship Center. Never heard of it in my life. I spoke to a woman called Denicia, and we were at a really pivotal time. We were trying to close our US account. Money was really thin, and there was a certain degree of unpredictability. 3 days later, not even, 2.5 days later, is $175,000 wired into my account. From first conversation to close. That just came out of the blue and nowhere. And it was a seminal point in our business that gave us 4 months of runway. We closed our US reference account in the retail category. In our business, the billing is immediate, so cash is immediate. And that was a reference account that grew our US business, and away we went. And it literally came down to that tweet from BDC from some group I've never heard of. And I was a guy who spent 10 years in the Canadian ecosystem, and it turned the ship for us. So there's all sorts of other things that come to bear, which are really quite interesting. But the right-hand side is an entrepreneur. So the considerations that I think, if you've gone through the exercise and you've asked yourself those questions, and you've been honest with yourself, the layer that you need to put on top of that is, what am I getting from my investor partner? Depending on where you play, there's governance requirements. So the institutions have a whole set of governance requirements and expectations. And as a founder, a lot of founders don't realize that if you bring an institution in the house and 2-3 years down the road, you're not executing on plan, you can get fired. It happens all the time. And people are saying, what the hell? I'm like, my baby, it's gone. I'm like, well, you should have known that going in. It's eyes wide open. Obviously, there's cost of capital considerations. That BDC loan that it came in, mind you, the one caveat on the BDC is there were a personal loan guarantee. So that was the risk we took when we brought it in. But it was a debt instrument at prime plus 1% that was non-dilutive to the business and got us through. We were having equity-based conversations at the same time, which may have cost us 15% of our company because we had no leverage and no negotiation. So there's cost of capital dilution, obviously trade-offs. The flip side is what you get out of your investors as well. So eyes wide open there. Clearly, friends and family can be a great source to get you off the ground, but you're not going to get a lot from them, depending who they are, obviously. As opposed to some of the institutional guys, the Omers Ventures, for example. I mean, part of their business is building a network ecosystem of senior contacts, and that can be incredibly powerful and helpful at the right time. So these are just some considerations that I find a lot of people don't. They're simple things, I think, but a lot of people forget to go through it. So really just in closing, I'd summarize, say, what do you do? Where do you go from here? Ask yourself the tough questions. Find yourself a mentor. Find yourself someone who's been through these different cycles and has a great perspective on it and can give you some guidance. None of it is rocket science. It's having been there, and you just don't know what you don't know. Research the various products. Everything I've seen, that list, everything's online. You can find endless information ad nauseam about all of them. So get informed. Warm introductions, they're always paramount. So that ties back to the mentor and whatever relationships you have or you can foster. Goes a long way. And then just get at it and hustle. Good things happen.